Hi guys, PC Crypto here. This episode is about derivatives and generally I want to explain to you options using Deribit as a platform. So options is one of the more advanced subjects and a lot of people are staying away and maybe good for them because options are also pretty risky if you think about it, but I wanted to explain it in a very simple way. So Deribit is one of the leading exchanges when it comes to crypto futures, crypto options and other markets that are more derivative in nature. So basically you can, after logging in, you have this screen of you being able to choose perpetuals. So I'll talk about perps in other video, as well as you will have futures for particular dates. But basically in this video I want to talk about options, and I will go to options on chain. This is for ETH. If you click it, then you basically will be able to see this kind of screen, and it might be pretty hard to understand what's really going on because if you scroll down, then you won't really see any kind of chart, right? You would expect some kind of a chart because you're used to trade with standard crypto where you can have only buy and sell. This is more complicated, and this is more complicated for a reason. So let's start with the thing that you have the dates here on above. Dates here means when the particular option expires. So when a particular option expires, some kind of action will take place, and Deribit is a platform where those kind of decisions are made automatically. So what kind of decisions we're talking about? Basically, you can think about options as betting on Ethereum, because this is Ethereum in this example, but you can go with Bitcoin, Solana, and probably other coins as well, that Ethereum will reach a certain price. And if it does, then you earn the premium, or you lose the premium, or a couple of other things can happen. So let's look at the very first example you can have. You have the 12th August, right? You have 600. 600 refers to the price of Ethereum, and basically, if you were to buy this, if you were to buy the call option, so there are calls and puts, and that also might be a little bit more confusing here. So call option is basically selling that you are eager to buy a particular token for this price at this date. So the call option for 600 with 12th August as expiry date means that you are willing to buy Ethereum for $600 tomorrow. Basically, I'm recording that 11th August. So on 12th of August you're willing to buy it. So of course there are like no call options because basically no one expects that price. But if you go down a little bit, then there's something funny starting to going on. So for example, you can let me see for the particular coin. Okay, so you have 1,600 basically. There are both sides. So now if I click it, then what I will see is I have a call option for 1,600 for Ethereum for tomorrow, and I can both buy and sell this call option. So if I buy the call option, it means that I believe that the price will go above 1,600, 1,600, and if that is really true, so for example, if tomorrow price of Ethereum will be 180, 1,800, then basically I will earn $200, right? If I were to buy one option. Now, so let's go with that simple scenario. Let's say tomorrow I believe that Ethereum will reach 180, 1,800. I'm buying this call option for the call option 1,600. So let me see the price. So the price here, it's the price is basically in Ethereum. So for the price of Ethereum, yeah. So this is $47, right? You can see that it's $47. So here's the funny thing. So this is for buying. So this is the buying bid. I would be buying this thing from the guys who are selling this thing. So the lowest price I can pay right now is 0.18 of Ethereum, because everything is priced in Ethereum. So it's $340, which means that in order for me, for this call option to be profitable, if I were to buy it for $340, then basically it would have to go above $1,940, right? Because it needs to go above the strike price. So this is the strike price, 1,600, plus the premium I paid for the call option. So $340 in this case. If it's below that, then a couple of things can happen. So if it's in general, if it's below the strike price and you're buying the call option, then basically nothing happens, right? You're just losing the premium. The option is not realized because you're not taking the bet in that case, because you were thinking about buying this for 160, and basically if it's below, then the option just expires, nothing happened. However, if it's above, then you're earning some kind of money. So for example, if it's so in this scenario that I believe that tomorrow, for example, it's 1,800, I'm buying that for 340, then it means that I'm actually earning $200, but then I paid for the option 340. So in general, I lost 140. That's why the guys are trying to buy it for $47. That's the highest bid right now for this kind of option, because they believe that, it's a fair price, it's a fair risk. The Ethereum price might go down. In general, you can think about it also like you can sell the call option, and that is an interesting case, because selling or shorting in this case for 340. So you'll be basically going into means the selling means the following thing. That's the reverse of the call option. So in the call option, you're saying you're buying for this for the particular price. If you sell the call option, it basically means you must sell at a given price. And if you believe that it's going to be below that price, everything is fine. So you basically selling the call option means that you believe it will go below $1,600. And if it goes, then basically, you're earning the money, again, depending on how low it will get there. However, if it will go up, but by much higher, then you have the infinite potential of losing the money. And this is the interesting case. So I don't want to dwell into that too deeply, but basically you can have infinite losses when you short options, because especially in this case, if you sell calls and the particular token will go much higher above, you can lose really a lot of money. So that's why it's really risky to play around with options. On the other hand, playing around with just buying calls, it's probably the easiest thing, or buying puts, because which I'll discuss in a moment, because you only risk the premium that you're paying. So let me, before talking more about shorting calls or shorting puts, let me talk about puts as well. So puts are basically the same thing. It's basically saying that you are willing to sell a certain token at a given price. In this case, depending on the market, sometimes you need to have a particular token or not. So puts option were created because people wanted to hedge their risk, and basically they were willing to sell at the given price. So for example, in this case, if you have to look at only the first option start much later, so with the strike price of 750, and again, you can, for example, buy the call option for basically $1. So what it does, or actually buy it for 284, because that's the highest sell price. The buying price is that thing. So if you were to buy it for 284, what a put option does? So put option basically says that you're willing to sell this particular the Ethereum token tomorrow for 1,750, which means two things. if the token is above that price, you're basically losing money, right? Because you're willing to sell the token for the price that is lower on the market. So if tomorrow the price is 1,800, then basically you're losing the money. Option expires, it's worthless, nothing happens. However, if it goes below 175, then basically you're making money, right? So if tomorrow the price of Ethereum is 1,600, then basically you can earn $150 minus the premium that you paid. So you buy the option for 284. So that's the minus that you put. So this should be pretty straightforward, right? So buying the calls option or buying the puts, depending on whether you're more bearish or bullish. Calls if you're more bullish, then puts if you're more bearish. So if you buy a call option, it means basically you make money if the token go above a particular price. But then you just need to take care of like how much will you pay for the premium and is it worth it. So that's the computation you will do here. Buying puts, the same thing, but it's a little bit like shorting, but probably less risky. Okay, depending on like what kind of risk you're taking in general, what's your position and so on, but it's another way to hedge risk if you're bearish, because you can have tokens like Ethereum, but you want to take care of the fact that the Ethereum can go down. So for example, when we were at the top in November or December, the Ethereum was for 4,800. Then basically the smartest thing you could do back then was buying puts for something like 4,000, so even below the ETH price for the next half a year. So this would be the expiry would be probably something right now, and then you would earn the premium plus you would earn whatever is the difference between the price back then and now. So probably a couple thousand of dollars per option. This is why it's so interesting. Same here. Like this is the price. This is with the expiry date for tomorrow. But you could go, for example, to down below to let me see. Yeah, this is the 31st March of 2033. So basically, it's something which is in 231 days. And basically, if you're like long-term bullish for Ethereum, then probably it's smarter to start buying call options, because then you could basically hedge this risk that, well, people are thinking super short-term in crypto, right? So you could start buying the options right now for like, well, you should really look at the prices, right? Because, for example, there's like a strike price 1,000, the option calls 1,300. So basically, if you are making money, if Ethereum will be over 2,300 by the March 2033. If it's much above, you're making money on that. So it's an interesting thing here. Again, let me go back to selling puts. So selling puts means that you're actually willing to buy at a no matter what is what happens in. So if you're buying the puts means that you sell at the particular price. Selling the put means that you buying at a particular price, but you have to buy. So the difference between selling put and buying call, because you might think that this is the same thing. The difference is that buying calls has this limit of how much you can lose, because you can always lose only the premium. Selling put will actually give you the unlimited losses, because you have to make this action. So the difference is basically this. If you buy a call, then, you know, if it goes, for example, you buy a call with the strike price of 1,600, then if it goes below, no matter how much it goes below, you will always lose on the premium. The option that does expire. However, if you were to sell the put for the same strike price, then actually what happens is, if it goes below, for example, like to $1,000, then not only you gain the premium, however, because it's like the opposite, but you lose $600. And your losses here can be really infinite. Basically, if it goes to zero, like everything goes to zero. So that's the same thing for selling call options. Selling call options is almost like buying put. However, you have this unlimited losses available, because it's not you who are deciding whether you want to take the particular option or not. So basically that's it. That's the basics of like what happens here with the options. I will be probably coming back to Deribit. Of course, none of that is financial advice. It's purely educational. Also, I really don't recommend for any beginners out there to start playing around with options, because you can quickly lose much more money than anywhere else. However, it's really good to understand what's really going on, especially as crypto advances into the world. You can think, and the fact that it's important is because in the traditional financial markets, you have many more people. Actually, there's much more capital in the derivative market than it is in the traditional market. So there are much more capital in the options or in the much more complex derivative structures than it is with, for example, stocks. This is not the case with crypto yet, but I think it will happen over time. Once we have more professionals coming into crypto, they will want to have more complex structures to short, hedge their risk, or do other funny stuff with those things. So yeah, thank you for watching. I will leave the link down below to Deribit platform. As you have seen, this is pretty straightforward once you understand all the numbers. Go around the platform, see whether you like it or not. You can also go more traditional with perps and futures. There's a bunch of other things on the platform as well. I really like it. I use it for options because, yeah, I was trying to play around. I'm not an option trader, so I was also doing it for fun and for the learning experience. But let's see what comes out. Thank you for watching. Subscribe to the channel and see you in the next episode.